You're listening to Ron Siegel's Home and Finance Radio Show, only on Financial News and Talk. Now live in studio, your host, local and national real estate expert and consumer advocate, Ron Siegel.
And hello again. Welcome to Ron Siegel Radio. This is the show with no real boundaries as we discuss current events, financial markets, politics, sports, even poking fun at the rest of the media. This is the show that connects the dots of confusion delivered by conflicting media reports. We connect the dots so you know the actions you can take, how your family or business can benefit from current events most of all. Thank you for joining me. Within every market, there are solutions as well as tremendous opportunities. You just need some trusted guidance. That is my message, and I will be delivering it every day. We have a very focused show. We only chat about items that affect the roof over your head, your bank account, and anything I feel would benefit you. But before we get into our intriguing content today, please join me in welcoming our featured guest. Todd Halterman is back. Welcome, buddy.
Good morning, man. That song never gets old. It's so nostalgic.
It is. And I'm trying to look out the back window there. I don't know if that's a screensaver or what you've got behind you, but I don't see quite as much snow as last time you were on.
No, sir. The snow's been melting off. Just residual piles of snow and a lot of rain and 38-degree weather. So,
something I hear people complain all the time about you guys having cold weather. My wife told me on the way out the door today, actually she's not home right now, but she said, wear a short sleeve shirt. It's nice out. It's going to be great. I walk outside. It's 45 degrees. So, you guys at 38, we're at 45 right here. Not a whole heck of a lot different. So,
no, I was in Arizona last week and it was about the same. It was very chilly and I had to wear my coat.
Yeah. And we even got rain in California. It never rains in Southern California, but we got a little bit. Hey, let me remind you, if you ever have any more finance-related questions, I am the consumer advocate looking out for you. And you can reach out to me directly, 800-306-1990, 800-306-1990, or ronsiegelradio.com. Just remember, that's the number you call anytime for assistance. When you call that number, it comes directly to me first. There are operators standing by.
Quiet, numbskulls, I'm broadcasting.
Well, I do have a great team. When it comes to developing a financing plan or plan to save you money, I personally work with you. Even if you don't have any needs today, save this number in your phone for future reference, 800-306-1990, 800-306-1990. And yes, of course, we are celebrating today. We celebrate every day on Ron Siegel Radio. I don't know about this one. National Bootleggers Day. I think we could celebrate bootleggers after a long weekend. I don't know. We might want to go with coconut water. I'm not sure, but that might be an idea because it's also National Hot Buttered Rum Day. Now that one we might need because, like Todd and I have both said, it's a little bit chilly outside, so nice warm drink might be beneficial. Let's see what the markets are doing right now. The Dow Jones Industrial Average misleading us. So the Dow Jones right now, as I chat with you, is down 323 points, 324 points. And I know if you're listening to us on ABC News and Talk AM 1490, we record in the morning about 9 a.m. If you're listening to us in the afternoon, the markets, I'm sure, have changed from where they are right now. But the reason I say that the Dow Jones is misleading us today is it's down 325 points, and probably 2/3 of that, maybe a little bit more, is attributed to Goldman Sachs and Travelers, two companies that are really just driving the market down today. So it's not a real indicator of what the markets are doing. S&P 500 gives us a little bit of a better indication, down 2.09. NASDAQ is up 6.13. Oil is up 43 cents a barrel to $80.29 a barrel. And I'll look at it. What the heck? We're looking at gasoline here in the formerly Golden State, $4.42.5. Josh, you're over there, $3.95, holding there below $4. Todd's in America at $3.39 a gallon in Idaho. You in Idaho today, Todd?
Yes.
Yeah, $3.39 is the average for the state of Idaho. Over $1 a gallon cheaper than we are here in Southern California. Jody's at 304 a gallon in Arizona. Brittany's at 343. This is our team around the country. Brittany's at 343. And our tremendous underwriter, Lori, it's her birthday today, and I won't say how old. $3 a gallon in Louisiana. So happy birthday, Lori, and $3 a gallon of gasoline. I am envious. But let's take a look and see what's going on in the world. The news. Okay, so we talked a little bit about the Dow, and we talked about where the markets are doing. Josh, we're going to have to write this one down. May 10th. May 10th is a big day for those of you that are on the real estate world. Why is May 10th such a big day? Normally I would share this in the Mortgage Minute, but I'm just going to throw this out there. May 10th. Okay, so here it is. That is the date when we're going to actually start to see interest rates drop. Now, Todd, you were at a conference last week or two, right? I think that's what you mentioned to it.
Yeah, it was an economic summit.
Were they as specific as I am? May 10th is the date that the interest rates are going to start dropping?
Well, analysts and technical people won't define a date just out of broad terms, and it sounds promissory in our industry. So they said at the beginning to mid-second quarter, we should start seeing relief in the capital markets relaxing for interest rates. So that's about as specific as you'll get from a chartered financial analyst or economist.
Okay, I'm a radio guy, so I can throw this out there. And what I did is I'm gonna go on the calendar and we're gonna put on there May 10th so we can look at that. And on May 10th, what I'm gonna do is I'm gonna reference the broadcast that I did with Todd Halterman on January 17th, where I said that interest rates will start their downward trend on May 10th. Now, why am I so specific? And all of these geniuses, they're not nearly as specific as I am. Well, I'm going to tell you why. The issue is that I'm looking at what are the markets going to do? What are the trends showing us for inflation? Right? The inflation, I've shared this many, many times. Inflation is the arch enemy of bonds. So what is so special about May 10th? Well, that's when we're going to get a CPI number. And that CPI number is going to be the first time when the stars will align. And that's why I like to look at that number. The stars are aligning then, because what's holding our CPI number back right now is a lagging indicator. It's called shelter, and it is 39% of the CPI number. So that would be the cost of the roof over your head. It doesn't account for tents. If you're homeless, this isn't about you. So those of us that prefer the roof over our head, on May 10th, when the CPI number comes out, that's when we're going to start seeing the numbers that are prior to that are high enough that as we continue on this projection, we'll start seeing benefits because we're replacing higher numbers in the CPI from the prior year with what'll probably be lower numbers. So the shelter number in April, which will be reported May 10th, is 0.5%. The CPI number is 0.6%. Now, what have we been running lately? So December's number, for reference, on shelter was 0.8%. Now, we all know that housing has been flattening off, if not declining a little bit, the cost of housing. We all know that the CPI numbers, the other inflation items, the other 61% that's not shelter, has been coming down a little bit, or it's moderating a little bit. So we replaced the December number from last year with December's number last year was 0.6. This year it's 0.3. So think about the way these numbers are lining up. And I don't want to get too much into the weeds here. I probably already have. But the bottom line is that the numbers, the way the forecasts are, when we replace high numbers with low numbers, we start seeing a bond-friendly environment. Now, does that mean the stock market's going to go up or down? No, I don't know. I'm just talking about home loan rates, which is driven a lot by the inflation world. And unfortunately, Jerome Powell has not been listening to Ron Siegel Radio, but we appreciate that you are. You can reach me anytime. Our off-air number, 800-306-1990. We're going to chat with Todd Halterman about tax season. Recession, the storm is on the way. Everyone's expecting a recession. Just a hint of what I'm going to ask Todd Halterman. When everybody has the same opinion, doesn't that mean the opposite's going to happen? We're going to ask Todd about that when we come back. We're going to also chat about what past recessions tell us about the housing market. And if I get to it, how to ask your credit card issuer for a better deal. All that and more. You can reach me anytime. Off-air number 800-306-1990, 800-306-1990, or RonSiegelRadio.com, Facebook.com/Ron Siegel Radio. And if you miss any part of our broadcast, Ron Siegel 1 on YouTube. Ron Siegel, the number 1 on YouTube. Stay tuned. We'll be back in just a few.
Ron Siegel Radio, your home and mortgage connection.
Are you like many of your neighbors trying to figure out how to pay off your debts so you could retire someday? Build bigger savings. Invest in opportunities. Visit rsrnodebt.com. Debt will destroy 50% of Americans from being able to retire earlier and with more. What if you could have a guaranteed program that could show you how to eliminate all of your debt in 10 years or less, all without having to spend more each month than you spend right now? Yes, that's correct. All without spending more from your checkbook each month than you are today. Get your free analysis today to see if you qualify. Visit rsrnodebt.com. Log on today for your free analysis, rsrnodebt.com. No purchase necessary. The free analysis takes only 2 minutes. rsrnodebt.com. Ron Siegel Radio is your home and mortgage connection. Go to rsrnodebt.com. rsrnodebt.com.
Are you paying rent because you cannot afford to live in your dream home? Are you paying rent because you don't believe you have the down payment funds to purchase your own home? At Siegel Lending Team at ronismylender.com has up to $25,000 to help qualified people purchase their own home at amazing interest rates. Contact the Siegel Lending Team today at ronismylender.com. Again, ronismylender.com. Licensed under NMLS 217037. ronismylender.com.
Homeowners over the age of 62 are taking back financial control after retirement with reverse mortgages, and the Siegel Lending Team is here to help you use it to your advantage. Call Ron Siegel with Geneva Financial to receive your free information booklet with no obligation. The booklet answers all your questions, and the best part is, you still own your home. Call Ron Siegel at 1-800-306-1990 or visit RonSiegelRadio.com.
Are you earning a safe, secure 10+% return on your investments? Is your credit score over 800? Are you living in the home of your dreams or simply where you think you can afford? If the answer to any of these questions is no, what are you doing about it? Text ATP to 79564. Complete a 3-minute complimentary survey, and the area trusted professionals of Ron Siegel Radio will reach out to you to develop a success strategy for you. Again, all you need to do is text ATP to 79564.
Do you know a homeowner experiencing divorce? Do you know a real estate reference and the divorce decree could cost tens of thousands of dollars? A certified divorce mortgage planning and real estate report could save you thousands of dollars, and it's free from your local certified divorce lending professional. Reach out to Ron today. RonIsMyLender.com. Again, RonIsMyLender.com. Licensed under NMLS 217037, Equal Housing Lender.
You're listening to Ron Siegel's Home and Finance Show with local and national expert Ron Siegel. Now, here's Ron.
Welcome back to Ron Siegel Radio. Within every market, there are solutions as well as tremendous opportunities. You just need some trusted guidance. That is my message, and I will be delivering it every day on Ron Siegel Radio or anytime at 800-306-1990, 800-306-1990. The Mortgage Minute today being brought to you by our friends at Geneva Financial. When you're ready for that next home loan, Geneva's got the programs and the products. You just need to make the call, 800-306-1990, 800-306-1990. S&P 500 now down 5.49. Going the wrong direction, but it is what it is. The 10-year Treasury, let's see what that's doing. We're right in between a couple of technical areas. So we have been watching that for you. My computer is moving extremely slow right now, so trying to get that back. Let's go to the other section and see if that'll tell me what the 10-year Treasury is doing. 3.519 up just a touch right now, so it's not a whole heck of a lot. And let's take a look at OBMMI. Every morning at this time, they provide the most comprehensive, accurate, timely, and interactive analysis of pricing ever conducted in the mortgage industry, calculated from actual locked rates with consumers across 35% of all mortgage transactions nationwide. 30-year conforming loan, 6.192, up a little bit. 30-year jumbo, 6.027, down a little bit. 30-year FHA, 6.192, up a little bit. The 30-year USDA rural areas, generally no down payment, 6.184. And the 30-year VA loan, 5.938. That was up a little bit. And again, none of these tell us how many points people had to pay to get these numbers. It doesn't show that part of it. It just gives us the raw lock data. So we're watching all of that very, very closely for you. But the reason we want to talk about this is the why. So I am going to throw this out there just because I can. So on November, we told you last year to look at November 10th as the date that we would see core CPI inflation make a turn lower. Yeah, sure enough, it had one of its best days of the year, leading to a decline in rates. Now, again, we're looking forward. We're going to believe that the second quarter will be a very good period of time for inflation to move lower, causing another meaningful leg lower in rates. Specifically, as I mentioned in the last segment, May 10th is another day to circle on your calendar. You know what the beauty is of this? And I'm going to talk to Todd about this in a minute. But, he goes to these economic places, and they've got all these really, really smart people. And they take the data that is given to them, like people like Todd. He'll take the data that's given to them, and they use that, and they share that, and they got to hedge it because, they, if it's wrong, they don't want anybody to invest based on, faulty information. But they keep it. The beauty is we're doing a radio show. And on May 10th, if my prediction doesn't come out to be as I said, well, we just let it slide under the carpet. Nobody knows any different. I'm just kidding. We'll talk about it. But something we did talk about, this being November 10th was going to be the date because of the rolling periods. So January CPI is released February 14th. We got a high replacement of overall core, low replacement of shelter. May not see anything meaningful there. February CPI is released on March 14th. High replacement of both core and shelter. Could be a good inflation drop on that date. March CPI released April 12th. Low replacement on core, high on shelter. So again, not a lot of progress. And the April CPI, which is released on May 10th, high replacement of core and shelter. And this continues for the entire quarter. So May 10th should be that start for another big leg down in the interest rates. Manufacturing continues to show weakness. The ISM Manufacturing Index showed that last 2 months of 2022 ended in contraction. The first 2023 regional reading for manufacturing activity released for New York showed that activity plunged to down 33. This was much worse than estimates of 8.6. And you remove the low from COVID. This is the worst reading since March of 2009. Other notable findings from the internals: new orders went from down 3.6 to down 31.1. Shipments dropped from 22.4 to plus 5.3. Backlogs fell to 14.3, are in contraction for an 8th straight month. Inventories rose slightly. Prices paid fell a sharp 17 points to 33. Employment dropped 11 points to the lowest since September. Work week fell further below zero at negative 10.4. That's just for one region. See what happens on the rest. CoreLogic single-family rent report that price gains decelerated in November to plus 7.5% from last year, which is a slower pace of increase than the 8.8% in October. Still almost double the average rental year-over-year increase pre-COVID of about 4%. But this deceleration will help inflation move lower once it catches up in the numbers, which we think will happen in the first half of 2023. A lot of data coming out this week. I'm not going to go through all of it, but that is the Mortgage Minute, brought to you by our friends at Geneva Financial. When you're ready for that next home loan, Geneva's got the programs and the products. You just need to make the call. 800-306-1990, 800-306-1990. So let's bring our friend Todd Halterman back to the conversation this morning. Tax season, Todd. It's I just saw tax season is up and running. We can start getting our W-2s are out. A lot of companies are just do it electronically, so it doesn't take a whole lot of time. It's not like it used to be. But what do we have to expect this year? I just saw that, in Orange County, California, we get an extra month to fill out our taxes or file our taxes this year. Is that all over the country?
The extension for tax filings.
Yeah, we got an extension here. I don't know if you saw that because you're in Idaho, but because of a natural disaster, Orange County, California is part of a natural disaster. I think it's just the natural disaster I see is Sacramento, but that's a whole different story. Right? But we get an extra month to file taxes out here because of the natural disaster.
Yeah, no, I don't think that's nationwide. I haven't gotten any word of that up here in Washington and Idaho, but I'll have to look into that.
So what are the highlights that you're seeing? I know, and this is one thing that I talk about all the time is that, any of us, anybody, I guess, around the country, you probably are not up to the latest, maybe you are, but the latest code in plumbing and electrical and construction, because you're busy working in financial planning, just like the construction worker probably isn't up to the latest of what's going on. You have to go and get that continuing education. I know you spent a week's tough life in Arizona, getting educated. So what's our takeaway?
Takeaway is right now that the American attitude is almost a self-fulfilling prophecy of recession. Never before has our economy seen a recessive environment coming on where everywhere you look, there's help wanted signs. Manufacturing seems to be getting caught up on its backlog, albeit not quite yet. The China shutdown has affected a lot of distribution and lag time. That should be correcting itself further into the year. Corporate America is flush with cash. I mean, we've got a lot of broken stocks out there, Ron, but we have a lot of profitable companies and companies that aren't broken. And the outlook is make sure you're in companies that have strong profits, that aren't high growth oriented because they're most volatile in these type of environments. And we're looking for long-term expansion second half of the year. But it could be a little slower than we expect because of the doom and gloom of recessive belief. But corporate America is flush with cash, Ron, and buying profitable companies whose stocks are broken like Microsoft and Google. There are a lot of companies out there with high profits. Their stocks are down 20, 30, 40%. And frankly, from a long-term perspective, way overcorrected and a great value to buy.
Can you help me understand what do you mean by a broken stock? When you say Microsoft is broken, what does that mean?
Well, if you're a company that put out toys that had lead paint in it, that's a business risk. That business risk will affect the company's stock when they have to recall all those toys and lose profits. That's a business risk. Market risk says in a rising interest rate environment, in a rising inflationary environment, with companies that want to grow, and it's hard to grow in these types of environments, their stocks get hit extraordinarily hard because that industry or that marketplace, the technology sector, the banking sector, some of these sectors affect the stock pricing, so it breaks the stock price, but it hasn't changed the profitability of the underlying company. An example is in 2008, Hugh Hefner got on TV and being interviewed by Matt Lauer on Today, and he says, "Hugh, do you have any regrets?" And Hugh said, "Yes, I have one." And Matt Lauer laughed and said, "What's that?" He said, "Well, I wouldn't have taken Playboy stock public because my company is worth way more money than the price of that stock reflects today." So if Americans were listening at that point, they should have loaded up on a broken stock, but not a company who's not profitable. So you can have a broken stock and have it be down, but that company, underlying asset values and profits, can still be strong.
So should I be looking at the Dividends for companies like that, being that you said companies have a lot of, they're flush and their prices are down. Is dividends a good way of identifying some of that?
Dividends can be a good way of identifying who's putting out profits. Companies like Chevron and McDonald's and KeyBank. You could also be looking for earnings per share. There's a thing called EPS. That just goes to show you at the current price of a stock, how much is it earning for the stock price. So if you have a stock at $20 a share and it's got a $2 earnings per share, that just tells you something, that it has strong earnings and profits based on its stock price. That's a profitable company.
So for years, we were looking at watching companies that, they're making no money and the stock prices are going crazy. So is that the companies we should be staying away from now?
Yeah, companies like Tesla historically have had huge negative earnings per share, and due to pop culture and social trends and the hope and desire that market in electronic vehicles, Tesla will continue to dominate. Well, today, if you look at their corrected stock price, their earnings per share is now positive. So their stock is fairly valued. But yeah, there's companies out there like Shopify and all kinds of tech companies right now who have huge negative earnings per share, but their anticipated market share and growth outlook can be huge. But right now, it's a good time to hide in dividend-paying companies who have huge amounts of cash on their balance sheet, who have a long history of profits. Coca-Cola's had profits every year for almost 30 years. I think Dow Chemical is 59 straight years of profits, growing profits. These are organizations that have weathered many recessive environments, and they put out profits and people can hide there.
Sounds a little bit like Berkshire Hathaway's portfolio, but I'm not going to go there. Right? I mean, the guy's done pretty well for year after year after year. You're listening to Ron Siegel Radio, discussing your real estate current events and the financial markets. When we come back, what past recessions tell us about the housing market, how to ask your card issuer for a better deal, all that and more. You can reach me anytime off air, number 800-306-1990, 800-306-1990, or RonSiegelRadio.com, Facebook.com/Ron Siegel Radio. And if you miss any part of our broadcast, Ron Siegel 1 on YouTube, Ron Siegel, the number 1 on YouTube. Stay tuned. We'll be back in just a few.
Ron Siegel Radio, your home and mortgage connection.
Are you a veteran, own a home, and need money? The Siegel Lending Team is here to help veterans refinance and get the money they need. The VA 100 lets you borrow up to 100% of your home's value, refinance your mortgages, consolidate credit cards, and lower your payments by an average of $700 a month. And the Siegel Lending Team knows that character means more than a credit score. Call 800-306-1990. That's 800-306-1990. Rate subject to change without notice. Licensed by the California Department of Corporations, NMLS 21037, and DRE number 018694452.
Are you earning a safe, secure 10+% return on your investments? Is your credit score over 800? Are you living in the home of your dreams or simply where you think you can afford? If the answer to any of these questions is no, what are you doing about it? Text ATP to 79564. Complete a 3-minute complimentary survey, and the area trusted professionals of Ron Siegel Radio will reach out to you to develop a success strategy for you. Again, all you need to do is text ATP to 79564.
Are you a renter and tired of making monthly payments? Paying off someone else's mortgage? Hey, it's Ron Siegel here to help you stop renting and start owning your dream home with amazing low interest rates. And you could potentially qualify for a $500,000 home for less than $5,000 out of pocket. So stop renting. Start owning with Ron Siegel. Learn more at RonSiegelRadio.com and start owning today. Licensed under NMLS 217037, Equal Housing Lender.
Are you like many of your neighbors trying to figure out how to pay off your debts so you can retire someday? Build bigger savings. Invest in opportunities. Visit rsrnodebt.com. Debt will destroy 50% of Americans from being able to retire earlier and with more. What if you could have a guaranteed program that could show you how to eliminate all of your debt in 10 years or less, all without having to spend more each month than you spend right now? Yes, that's correct. All without spending more from your checkbook each month than you are today. Get your free analysis today to see if you qualify. Visit rsrnodebt.com. Log on today for your free analysis, rsrnodebt.com. No purchase necessary. The free analysis takes only 2 minutes. rsrnodebt.com. Ron Siegel Radio is your home and mortgage connection. Go to rsrnodebt.com. rsrnodebt.com.
You're listening to Ron Siegel's Home and Finance Show with local and national expert Ron Siegel. Now, here's Ron.
Welcome back to Ron Siegel Radio. Within every market, there are solutions as well as tremendous opportunities. You just need some trusted guidance. That's my message, and I will be delivering it every day on Ron Siegel Radio or anytime at 800-306-1990, 800-306-1990. The real-time real estate segment today being brought to you by the area trusted real estate professionals of Ron Siegel Radio. Visit rsrhomescout.com, rsrhomescout.com. What past recessions tell us about the housing market, it doesn't matter. If you're someone who closely follows the economy or not, chances are you've heard whispers of an upcoming recession. Economic conditions are determined by a broad range of factors, so rather than explaining them each in depth, let's lean on the experts and what history tells us to see what could lie ahead. As Greg McBride, chief financial analyst at Bankrate, says, quote, 2 in 3 economists are forecasting a recession in 2023, unquote. As talk about a potential recession grows, you may be wondering what a recession could mean for the housing market. Here's a look at the historical data to show what happened in real estate during previous recessions to help prove why you shouldn't be afraid of what a recession could mean for the housing market today. A recession does not mean falling home prices. To show that home prices don't fall every time there's a recession, it helps to turn to historical data. And I've got a graph that illustrates looking at recessions going all the way back to 1980. Home prices appreciated in 4 of the last 6 of them. So historically, when the economy slows down, it doesn't mean home prices will fall. And again, if you're watching us on RonSiegelRadio.tv, any of our socials, the ABC News and Talk AM 1490 video feed, you are seeing the chart of a recession does not mean falling prices. Again, we've out of the last 5 recessions, 6 recessions, I'm going to say real estate values only dropped in the 1991 recession. That was down 1.9%. 2008, I'm not going to say that real estate values dropped because of the recession. I think there was a recession caused by real estate. So this is all numbers coming from CoreLogic and The Balance. Most people remember the housing crisis in 2008, the larger of the bars on the chart that we're showing you, and think another recession could be a repeat of what happened to housing then. But today's housing market isn't about to crash because the fundamentals of the market are different than they were in 2008. According to expert, home prices will vary by market and may go up or down depending on the local area. But the average of the 2023 forecasts shows prices will net neutral. I'm going to say up a little over 2%. A recession means falling mortgage rates. Research also helps paint the picture of how a recession could impact the cost of financing a home. Another graph, historically, each time the economy slowed down, mortgage rates decreased. So you can see that in the last 6 recessions, how mortgage rates have gone down during recessions. And the Federal Reserve, so far historically, we've never come out of a recession without the Federal Reserve lowering interest rates. Will this be the first time? Fortune explains mortgage rates typically fall during an economic slowdown. Quote, over the past 5 recessions, mortgage rates have fallen an average of 1.8 percentage points from the peak seen during the recession to the trough. And in many cases, they continue to fall after the fact as it takes some time to turn things around, even when the recession is technically over, unquote. 2023, market experts say mortgage rates will likely stabilize below the peak we saw last year. That's because mortgage rates tend to respond to inflation, and early signs show inflation is starting to cool. If inflation continues to ease, rates may fall a bit more, but days of 3%, I don't think we're going to get back there. But I said that once before. The big takeaway is you don't need to fear the word recession when it comes to housing. In fact, experts say a recession would be mild and housing would play a key role in quick economic rebound. As the 2022 CEO outlook from KPMG says, quote, global CEOs see a mild and short recession, yet optimistic about global economy over a 3-year horizon. More than 8 out of 10 anticipate a recession over the next 12 months, with more than half expecting it to be mild and short, unquote. Bottom line, while history doesn't always repeat itself, we can learn from the past, according to historical data. In most recessions, home values have appreciated and mortgage rates have declined. If you're thinking about buying or selling or borrowing on real estate, can I count on you for that introduction? That is the Real-Time Real Estate segment brought to you by the area trusted real estate professionals of Ron Siegel Radio. Visit rsrhomescout.com, rsrhomescout.com. And being that I'm still one course away from getting an economics degree, but I've been one course away for almost 40 years. Don't think it's going to change. I can say this. Todd, they probably didn't tell you this at the conference that you were at. Economists have predicted 11 out of the last 4 recessions. Just throwing that out there. So if you just a little humor there. Todd Halterman is with us. He is our favorite financial planner, not giving specific advice, but he is giving us education. If you want specific advice, that's what he does for a living. That's how he supports his family. So give me a call at 800-306-1990. Happy to put you in touch with our friend Todd Halterman. So Todd, one of the questions I want to throw at you, and it's something that I learned back in my days at Merrill Lynch a long time ago. So I was there just during the .com time frame. And one of the things that we talked about was when everybody is talking about the stock market and how great the stock market is, and that's the conversation around the water cooler, probably a good time to sell and get out, right? Because everyone's talking about it. They're so excited about it. They're mistaking. I'm going to date myself. We used to have to go to in the newspaper, they had these pages that were the stock where you could find prices of stocks because they weren't so readily available. And we used to say, well, you put the newspaper up on the wall, throw a dart, and you can find a winning stock. Not quite the same way today. But my question, Todd, is if everybody's expecting this recession, am I so far off to say, something, maybe we're not going to get a recession because everyone's expecting it? What do you think?
Yeah, the numbers are really funny right now as far as profits and earnings. Wall Street's gotten very greedy. So the markets have been overreacting to what I'll say neutral news. A company that isn't growing 20 and 30% year over year in profits or in distribution is now seeing a lot of negative impact of their stock price, but they're still profitable and still growing. So there's just a lot of greed in Wall Street really built up because the expectations changed from 19, 20, and 21. I mean, growth investors were up 60% over that 3-year period. So the 20% pullback, they've kind of forgotten that they went up 60% over 3 years, and they're just focusing on, oh, I gave back some profits. This is a time to understand long-term financial planning and put the down market to your benefit to work for you instead of fearing it. So the recession, I don't know. The answer is neither do economists. They're all guesstimating, but corporate cash is high. Company opportunities are there. Depending on where you invest in the market, you could be seeing profits. Like in the last year, aerospace and defense is up double digits.
So you may not be familiar with Doty's law of economics. So Jim Doty, former president emeritus at Chapman University, and they're usually one of the top, in the top 3 of all economic forecasts nationwide. Even though it's a small little school, they generally outperform Goldman Sachs and JP Morgan in their forecasting. And Doty's law says that whenever an economist tells you that they've got a 40% certainty that we're heading into a recession, what that means is they don't know what the hell they're talking about. So I just throw that out there for you. But what I'd like you to chat about, Todd, is, and I don't want to get specific on anything, but you may need to use a stock just for an example. But, you're talking about these companies that they come out and they report good earnings. That's, I think, what we want companies to do.
Sure.
But they're not in the 20 and 30% range. Maybe they're only at a 5 or 10%, which is still great. And the stock price gets hammered. Or a company like Goldman Sachs today, their stock is down dramatically. I don't think that the company is a bad company. I think it's probably a company that most people would want to invest in, and they've had a a pretty good track record historically. But, they're down 7.5% today. The question I would have is, number one, what are your thoughts on buying dips? And number two, if you like buying dips, do I go all in, or can you explain what dollar cost averaging is?
Yeah, well, successful investors are patient and they buy on dips, but it goes back to, why are they buying in the first place? The market buys up 6 months in advance. So are you buying it because it feels good, or are you buying it because it looks to be a profitable company with growing distribution, growing balance sheet, and growing profits? If those answers are yes, then you should be looking at them. When organizations like Tesla fall significantly and now they're profitable in their earnings per share, and they lead their industry and sector in what I would say opportunities, it's hard not to buy a Tesla or a Microsoft, who really truly have a competitive advantage over most of their peers in that industry. So, and I don't generally go all in on a stock, because you just can't guess this market, especially this first quarter. But dollar cost averaging is what a lot of people do in their 401k. Each and every paycheck, they take a little bit and they buy into the market on a regular interval. So they're catching the down market purchases, and as it goes up, they're buying shares, and that averages out to a better buy price. So a lot of times in this environment, over the next 4 to 6 months, we'll invest $100,000 in somebody's portfolio, $15,000 to $25,000 at a time, depending on what kind of sector we're in and what the volatility looks like.
So great information right there is to don't put all your money on red, right? That's basically, so you're saying, okay, something, we're going to do this over time. Now, Todd, you're not when you're talking about financial planning, you're not really talking about that guy that's out there buying Bed Bath & Beyond right now, trying to catch it on the right upswing before they file bankruptcy. You're talking about really good companies, right?
Those are people that take more risk than they get in returns, and those are trading and execution, offensive moves, if you will. Planning is simply this. We plan for profits. We plan for volatility. We plan for opportunity. And if you were a client of ours this time last year, we were loading you up on energy and aerospace and defense and industrial properties and multifamily opportunities, and then tax mitigation. So all of those things were things we adjusted to, and our clients are experiencing some significant growth from that and defending some of their poor positions, like Microsoft and Disney, who have been mainstays for many people and way down right now.
So you mentioned, Disney and Microsoft and those mainstays. I'm going to throw a curveball at you when we come back. You're listening to Ron Siegel Radio, discussing your real estate current events and the financial markets. You can reach me anytime. Our off-air number, 800-306-1990, 800-306-1990, or RonSiegelRadio.com, Facebook.com/Ron Siegel Radio. And if you miss any part of our broadcast, Ron Siegel 1 on YouTube, Ron Siegel, the number 1 on YouTube. Stay tuned. We'll be back in just a few.
Ron Siegel Radio, your home and mortgage connection.
Do you know a homeowner experiencing divorce? Do you know a real estate reference and the divorce decree could cost tens of thousands of dollars? A certified divorce mortgage planning and real estate report could save you thousands of dollars, and it's free from your local certified divorce lending professional. Reach out to Ron today. RonIsMyLender.com. Again, RonIsMyLender.com. Licensed under NMLS 217037, Equal Housing Lender.
Are you a renter and tired of making monthly payments? Paying off someone else's mortgage? Hey, it's Ron Siegel here to help you stop renting and start owning your dream home with amazing low interest rates. And you could potentially qualify for a $500,000 home for less than $5,000 out of pocket. So stop renting. Start owning with Ron Siegel. Learn more at RonSiegelRadio.com and start owning today. Licensed under NMLS 217037, Equal Housing Lender.
You're listening to Ron Siegel's Home and Finance Show with local and national expert Ron Siegel. Now, here's Ron.
Welcome back to Ron Siegel Radio. Within every market, there are solutions as well as tremendous opportunities. You just need some trusted guidance. That is my message, and I will be delivering it every day on Ron Siegel Radio. Or anytime at 800-306-1990, 800-306-1990. We're going to skip our report, Josh, on Your Credit Matters segment, but I'm going to tell you, because I want to talk more to Todd Halterman, but Your Credit Matters brought to you by creditsanitizer.com. You have a credit report and it's wrong. They're all wrong. What are you doing about it? Credit Sanitizer has these solutions for you. Go there, creditsanitizer.com. You're going to get a quick sign in just so we know who you are. We're going to send you back a link for a credit report. Credit report costs about $1. It's a trial. If you want to keep it, you get it for, I think it's $32, $33 a month. But we'll do a free audit for you. The audit's generally $197 for a short period of time. We're going to do that for free. But that's creditsanitizer.com. Continue our conversation with Todd Halterman. So before the break, Todd was mentioning these mainstays that are out there. And I think what you mean by mainstays, just for the simple guy like me, is these are companies that have been around a long time. They're going to be around a long time. It's kind of like set it and forget it. They're good for your retirement. So, and again, part of one of the issues that you've got going on is you got to be careful even of the mainstays. So mainstays sometimes take a turn. So Todd was talking before about companies that are in their, their number one or number two in their business, in their sector or their marketplace. And I would say arguably one of the greatest CEOs of all time was probably Jack Welch. And he was a CEO when GE was flying high. And GE was, people think General Electric. But General Electric was a massive conglomerate of a lot of companies. And if you go and read Jack Welch's book, his whole thesis was the company is either the number one or number two company in its industry, or they're going to get out of that portfolio. That's not going to be a company that they hold. So, Todd, one of the things that I wanted to ask you about, when we know that, Disney's been a great company for years and years. Microsoft has been a great company for years and years. But what are your thoughts? I mean, GE was a great company for decades. And right now, I don't even know if it's trading anymore. How do you manage that part?
Well, and again, diversification is key to success. You don't put too many eggs in one basket is the old adage. But when we use mainstays, it's because they've got a long track record and consistent history of profits, huge piles of cash on their balance sheet, and they have a compelling, distinct advantage against their peers in their industry. Doesn't mean that they can't fall and have a bad quarter or a bad year. An example of Disney is parks were shut down for a year and a half, and their media division stumbled a little bit in growth because of all the competition during the environment of lockdown and companies like Netflix that have taken on market share. So again, speculation and greed, but that allows Disney to challenge themselves to retool, get more efficient, and focus on the divisions where they're leading the charge. And Disney is a media giant, and Disney is an entertainment recreational giant, and they're leaders in the business consulting world. So focusing on those strengths will bring Disney back to the empire that it's always been, with competition, mind you. So you just need to understand the company and the why.
And therein lies the exact reason why you need to have a great financial guy on your team, right? Because you understand when you talk to somebody like Todd, Disney's, I love the company. My son works there, love the company. They've been great to our family. But if you look at what's been going on at Disney lately, their stock has sucked. Just calling it like it is, right? But when you listen, then you get the guidance from a professional who does this all the time for a living, not, somebody that's talking on radio or, I could tell you a lot about mortgages and a product that's got a 4% EPR right now. But the bottom line is you need somebody that really knows this stuff and studies it to be your financial guide. And if you don't have that, give me a call at 800-306-1990. I am not that person, but I can put you in touch with Todd Halterman. But Todd, as we go into a recession, and some of these companies, especially if you've got to be perfect or beyond perfect for your stock not to falter, what is out there right now that I can do for protecting the assets so I don't have to, so I can sleep at night? Are there products that you have out there that you know about that we can do these things with?
Well, buying the S&P 500 index right now is one of those buy entries where you're not sure of the real risk short term. Long term, we expect growth, but short term, how much are you willing to go down before it comes back up? So we, over the last 9 months, have been helping investors capture some of their profits or protect them. Ron, I don't know if you know this or not, but there are certain S&P 500 trusts that you can invest in that if the market goes down 10, 20, 30%, you actually get your principal back. These instruments are liquid. These instruments are held in a trust account through our organization or any other good, strong financial advisor. So these trust assets in the index can have principal protection. Some tools that we use, Ron, if an account is down 8%, their principal's protected, and that company will actually credit in the S&P 500 index 8% positive interest to their account. So a dual direction strategy is fun for us right now, because if an investor wants 10% protection of principal on the down, that means they won't lose any principal, 10% or less. They can also get their principal protected, but a positive interest given to their account. So I'll give you an example. $100,000 S&P 500 index trust would go down 8%. Your neighbor's at 92%. Your account would be at 108,000. So instead of being at 92,000 like your neighbor, the dual direction option allows somebody to be up 8% while their neighbor's down 8%. And in this environment, we have a lot of people asking for dual direction protection.
So I'm going to really hit you with a tough question right now, but you're a numbers guy and I'm going to put you on the spot. So think about this concept. So if your account is down 8%, and you're using small numbers, so it makes it harder for me because I can't do it in my head that way. But if your account is down 8%, what do I have to do? Go up, 20% just to get back to even? Something like that? 15%?
8% down means you're going to need to make 11% or so to go back up to get to even. So the neighbor that's at 92,000 is going to have to go from 92 to 100 to get back to even, and then up even 8% more to get back to 108,000, which the dual direction protection allows. And I have never in my 29-year career seen a liquid trust that gives principal protection and positive interest even on a down market.
So let's just throw this out there. So if we just go with the numbers that you just shared with us, and I think I got it right. So 92,000 needs to go up 11% next year to get back to even. Is that right?
Correct.
We've got this particular product that you're talking about, our 92 would actually be 108 this year because of the protection built in.
Correct.
If I take that 108 and that appreciates at the exact same 11%, am I right in saying that's about 129,000 in that same year?
Correct.
So I was at 129,000 versus 100,000.
That's correct. And the beautiful thing is these trusts are liquid, and in some cases they're no fee depending on the state that somebody lives in. So we have been able to save people management fees and give them some downside protection and keep the asset liquid and give them an opportunity for an up return in a down market. And here's the beautiful thing. Right now, at the rates that are issued, until the market goes up more than 21%, the investor gets 100% of the up. At 22%, they stop at 21.
What a shame. Right? If I could say, okay, I'm protected on the downside. Now I want to go one step further, and I know we're out of time, but think about this concept. This advice or this program that Todd's just talking about, I just showed you how you could be $30,000 ahead on a $100,000 investment with these hypotheticals. No, we're not guaranteeing anything. We're not saying that the markets are going to do these things. We're just throwing numbers out there for educational purposes. Now, what if this cost you 2% to do it? So what is 2% of 30,000? Is that 600? I think it's $600. So would you give up 600 for 30,000? And I do that all day long, right? I'd leverage my neighbor's house even, right? The concept here is great advice costs nothing, even though you're paying for it. Think about that. If you want to meet Todd Halterman, give me a call at 800-306-1990. They didn't have these products when I was at Merrill Lynch, I can tell you that, or at least I didn't know about them. But give me a call at 800-306-1990, 800-306-1990. And as always, I ask, set that first radio preset button to come back here and join Ron Siegel Radio, where we only speak about items affecting your house and your bank account. Thanks to all of our sponsors. A big thanks to Josh and Sean who are engineering us today. And, of course, a special thanks to you for spending a little bit of your day with us. That's all for Ron Siegel Radio. Again, if you have any questions or to meet any of our guests, call me anytime, 800-306-1990, 800-306-1990, or ronsiegelradio.com. And remember, make a lot of money so you can help a lot of people and have a lot of fun. Have a great day. We'll talk to you next time on Ron Siegel Radio.